Good morning and happy Monday, you magnificent melonheads. Today is April 24th, 2023, and we have got a big week ahead of us this week. A lot of earnings coming in, a lot of big names. And while all these earnings are going to be coming in all this week, we've also got the fact that the bank run never actually ended, despite all those reassurances. And remember all those comments from Secretary of the Treasury Janet Yellen that our financial system is strong and resilient. Remember how many times she reassured us that? Well, those deposit outflows never stopped from any of those banks. There was 1 week where there was this tiny little uptick where deposits stopped outflowing and some came back in, and then right back down they resumed. We got some data from the Wall Street Journal over the weekend that reinforces this. And even this morning, we've now heard from Silicon Valley Bank that the deposit out withdrawals continue, even though First Citizens Bank Shares bought them out. Well, the CEO of First Citizens Bank Shares is saying, yep, they're still draining the money from Silicon Valley Bank. And then we've got Credit Suisse. Remember that one? They're still a thing. Well, Credit Suisse is still seeing deposit outflows over there, even though they've been bought out by UBS. Well, hey, that merger, the ink has not actually dried on that merger yet. They haven't actually sealed that deal. All the bank regulators in Switzerland want to assure everybody that that is a done deal, but it's anything but done. That's still going on. It could still fall apart. It's being challenged in court all over the place. They changed the law to make it happen. So this bank run, it's not over, folks. It's still happening. It's slowed down substantially from its peak in March. It has slowed down, but it's still happening. Oh, and by the way, commercial real estate, that remains the sleeping giant in our financial system. That's the crisis that's going to take everything down, and that hasn't even started to hit the banks yet. This was all just panic about the speed of interest rate increases that caused this bank run. The commercial real estate thing, that hasn't even started to rear its ugly head yet. So with that, let's shrink my big melon of a head and take a look at what's going on in markets this morning. Stocks are down only modestly right now. We got the S&P is down a whole 0.75 point, or 0.02% at 4132. The Dow is actually up 52 at the open. That's interesting. We were down right before the opening bell, and now it looks like it's popping up at the open. And we've got the NASDAQ is down 26 points, or about 0.2% at 12,049. The DXY, again, all over the place this morning, currently at 101.57, down 25 basis points. Still sitting right about the neckline of that head and shoulders pattern that I've been talking about for a couple of weeks. It still hasn't broken one way or another. We're going to be keeping an eye on this one. I've got a downside target of 88 if the neckline breaks on the DXY. Keep an eye on that one as well. Over in the U.S. bond market right now, check out the spread between the 1-month and the 3-month Treasury. The 1-month Treasury is yielding 3.4%, and the 3-month is yielding 5.19. That is somewhere around 170 basis point difference between a 1-month U.S. government bond and a 3-month. And that spread is only going to keep getting wider as the debt ceiling nonsense gets worse and worse and worse. And by the way, the reason why these deposit outflows continue at U.S. banks, why people are still draining their money out of the bank, is because they're putting it into money markets. Well, what do money markets invest in? Usually short-dated U.S. treasuries. So all these people are running from the banks and everything that happened at Silicon Valley and Credit Suisse and Signature and Silvergate, and they're dumping their money into money markets, and money markets puts that money into U.S. treasuries, which is ground zero for the debt ceiling. Everybody that's out of the frying pan and into the fire. This setup just sucks. The setup just stinks across the board, guys. This is going to be such a mess if this debt ceiling thing actually happens. U.S. 10-year, meanwhile, the yield is down about 3.5 basis points at 3.53, and the 2-year is yielding 4.16, down about 2.5. Over on the commodities board, folks, you can expect a price smash in the shinies today or tomorrow. We've got options expiration is tomorrow on 425. Well, typically right before options expire, the bullion banks come in, they paper over, they smash the price down, those options expire worthless, and then they rinse repeat. Well, right now, gold is flat. It's up about 85 cents at 1,991, back below 2,000. Silver is at 25.26, still above that 25 level, down about 2 cents right now. Elsewhere, we've got platinum still over 1,100, although it's down 34 bucks right now. Palladium's down about 60 at 15.47. Crude oil at 77.61, down about 25 cents, and natty gas at $2.38, down a couple of pennies this morning. All right, but here's the main story. Why the banking mess isn't over. This is in the Wall Street Journal, written by none other than Nick Timiraos, a.k.a. the Fed Whisperer, a.k.a. Nick the Pig, as my buddy Greg Manarino would say. Deposit flight and higher funding costs risk squeezing small businesses beyond big cities. And I want to scroll all the way down past all of this. First of all, take a look at this chart here. I got to zoom out a little so you can see this chart. All right, this is showing the flow of deposits, and you can see here's when the bank run started. All right, the bank run starts at small banks on about March 8th, March 9th timeframe, right? Now, all U.S. banks, deposits had been falling really since the beginning of 2022. So I just want to emphasize that this bank run, it was slow going for several months before things really went off the deep end in March. And that's when we saw this big step change down in all U.S. banks. Big banks here shown in light or in darker blue, they saw a lot of deposits, but the small banks is what they're the ones that really got hammered, the small banks. But you'll notice in the weeks since, right, despite being told really since the beginning of April, hey, everything is okay, the deposits have stopped flowing out. Well, that's not really the case, is it? We had 1 week here, 1 week between March 29th and April 5th, where deposits actually flowed back into some small U.S. banks. Not anymore. They're falling again. The big banks' deposits are still falling, and the average all banks is at its lowest point now. The data up until April 12th is the most recent data we have. People are still pulling their money out of these banks. And, you know, everybody's saying, hey, the crisis is over. Job well done. It's not over, folks. It's still happening. You see it on the chart. For hundreds of smaller banks, the likely solution will be to reduce lending. What's going on nationwide is every one of these banks has either frozen their loan-to-deposit ratio or more likely is very intent on shrinking it, said former Dallas Fed President Robert Kaplan, who had to resign in disgrace because of the insider trading incident, I might add. He said that on a call hosted by investment banking advisory company Everscore ISI this month. That's why a lot of small and mid-sized businesses in this country are getting a phone call saying politely, at the end of the year, we're not going to be able to give you a loan anymore, or we're going to reprice your loan. And this is showing all banks are showing higher standards for loaning to commercial real estate, for credit cards, for everybody. And why is that necessary if the crisis has calmed down? The problem, he said, is that more bank executives realize they may face losses down the road on riskier commercial real estate loans and commercial and industrial loans for which they haven't set aside enough of a cushion. Interest rate risk was the catalyst for the SVB panic. Banks pulled up their investment portfolios with mortgage-backed securities or longer-dated treasuries in 2020 and 21 as fiscal stimulus sent deposits flooding in. Higher rates lowered the value of those bonds, leading to potentially large unrealized losses on the securities holdings. Depositor anxiety could resurface if and when banks face worries over losses due to loan defaults. That's a big thing. When the commercial real estate losses start hitting the books, is that going to spook customers to start withdrawing their money the same way Silicon Valley's losses in bonds spooked their customers to start withdrawing money? The current bank crisis is in the second or third inning, not the seventh inning, said Mr. Kaplan. He thinks the Fed shouldn't raise interest rates until it has a better view of the fallout, particularly because it would be damaging to have to cut rates later this year to address a bigger crisis. I'm afraid we've got something coming that we don't fully understand, he said. And just to reinforce that, let's take a look at a couple of headlines that are coming out this morning. Check this one out in Bloomberg. This is dated just yesterday. Silicon Valley Bank still seeing outflows after First Citizens takeover, Financial Times says. The new owner of Silicon Valley Bank, which collapsed after a bank run in March and set off fears of a broader contagion in the global financial sector, said customers are still withdrawing deposits. Peter Bristow, president of First Citizens Bankshares, agreed to buy the California-based lender last month, and he said that they are still seeing outflows and called for patience from investors. He attributed the withdrawals to pent-up demand during the period in which the FDIC took SVB into receivership, and it became the largest U.S. bank to collapse since 2008. So the money's still being drawn out of Silicon Valley Bank, which is now First Citizens Bank, but the customers are still pulling their money out. Just because First Citizens came in and bought them up doesn't mean that crisis is over. Just now it's First Citizens' problem. Then check out Credit Suisse. Credit Suisse lost $68 billion in assets in the last quarter. Outflows continue. This is dated just this morning. Credit Suisse said on Monday that 61 billion Swiss francs, or $68 billion in assets, left the bank in the first quarter, and that outflows were continuing, underscoring the challenge faced by UBS in rescuing its rivals. Customer deposits declined by 67 billion francs in the quarter, and the bank noted many matured time deposits had not been renewed. So people are pulling their money out. People who have CDs, the CDs are getting paid back. They're maturing, and they're saying, nope, thanks, goodbye, see you later. They're out. Just because UBS came in and bought up Credit Suisse doesn't mean that bank run is over. Here you go. They're saying it's still going on. And by the way, folks, while all this is happening, we've also got this going on. Jackson Tower, a downtown Portland landmark, goes into default. Another story about a commercial mortgage going into default. Now, these are going to be all over the place in the coming months. An attorney for the owner blames the deterioration of downtown Portland. Obviously, the situation in America's cities is not going to help the value of the commercial real estate. In another blow to downtown Portland real estate, the owner of Jackson Tower, a landmark building that overlooks Pioneer Square, has defaulted on a loan from J.P. Morgan Chase, court filings show. Jackson Tower Partners, LLC, the owner of the 12-story Beaux Arts office building on the 800 block of Southwest Broadway, borrowed $11.5 million from J.P. Morgan Chase in 2018. They missed their first loan payment on November 1st of last year, according to a complaint filed with some county I can't pronounce on April 5th. So here you go, another $11.5 million on another big building. They stopped making their payments, and they're going to default on the mortgage. They're going to hand the keys back to J.P. Morgan Chase, and they're going to say, congratulations, J.P. Morgan. You are now the proud owner of a building nobody wants in a city where it's probably not safe to walk down the sidewalk. So this is going to continue playing out, and this has not even started to hit all these banks, which are still seeing deposit outflows. Elsewhere, in another story that literally everybody saw coming over the weekend, Bed Bath & Beyond announced that they are filing Chapter 11. They are officially bankrupt. Bed Bath & Beyond plans to swiftly liquidate and shutter stores. The retailer to wind down by June 30th. Still looking for a buyer. Customers told in an email coupons will not be accepted after April 26th. And good news, folks, that is one less piece of crap mail in your mailbox every week. Those Bed Bath & Beyond coupons are finally going to stop showing up at your house every day. We all knew this one was coming. We found out in the first quarter that they were down to $300 or $400 million in total cash left to operate. And at the rate they were burning cash, I remember saying on a live stream a few months ago, they've basically got 3 months to raise some capital somewhere, either through a loan or through issuing shares. They weren't able to do that. They're finally out of money, and now they are bankrupt. All right. We have got a big week of earnings ahead of us, folks. Let's just talk about a couple real quick. What's going to be hitting the tape this week? Today, we've got First Republic Bank reporting today. That's a big one. How much money was withdrawn from First Republic in the first quarter? How much did they have to borrow, and from where? Did they borrow from the Fed's discount window? How much did they borrow from Federal Home Loan Banks? How much did they borrow from the Bank Term Funding Program? All right, that's going to be a big one, the First Republic Bank shares. That comes out after the close. Keep an eye on that one. Coca-Cola reported already this morning. They had a decent quarter. We've also got KKR. That's a big commercial real estate borrower, big commercial real estate company. So look for those earnings to move markets. We've got Canadian National Rail is reporting today. I'm hearing a lot of trouble in the transports. That's going to be a good sign about how are things moving in the world of logistics. Then tomorrow, after the close, we've got Alphabet and Microsoft. There's a couple of trillion in market cap reporting. Also, we've got Visa. That's going to be a good barometer on the health of the American consumer. In the morning, we've got UPS. Again, another one showing the health of how much is things moving in the economy. We've got McDonald's tomorrow morning. That's basically a commercial real estate company, so McDonald's earnings are going to be interesting. On Wednesday, we've got Meta, and then we've also got Boeing. Those are two big ones. Thursday, we've got Amazon, MasterCard, Honeywell, Intel, Caterpillar. Talk about a good barometer for the health of the whole U.S. economy. Look at all of those names. And then Friday, we've got the big oil majors, XOM, that's ExxonMobil, Chevron, also got LyondellBasell, that's a big petrochemical company, and New York Community Bank Shares is reporting on Friday. They're the company that came in and bought the leftovers from Signature Bank. So we have got a busy week of earnings. I don't know which way it's going to go. Look, I wear it on my sleeve, Perma Bear. I'm always negative on any given day. But I don't see a lot to be optimistic about right now. We'll see what comes out. We'll see if that changes through earnings season. All right, guys, I just want to say thank you very much for your time. Thank you for watching. Thank you to my Patreon supporters. I appreciate everything you guys do for the channel. Link down below should you feel so inclined. Hi, Mom. Hi, Dad. I love you guys. And until next time, live small and dream big.